We believe the providers of the technology, the picks and shovels, will continue to produce enviable earnings growth. Nancy joins us now. What's a more promising pick and or shovel? Is it Alphabet or is it NVIDIA, Nancy?
Thanks for having me, Tim. I'm actually going to go, we own them both, and I'm going to go with NVIDIA. And the reason for that is I think analysts are forgetting, or investors are not focusing on CUDA, which is the software system that developers use around the NVIDIA chips, Blackwell, and then soon to be Rubin. And I think it's analogous to Apple and the App Store. So, it was just a handset company when we were buying it. I was told that every time I talked about it on the air, but it was really the App Store and services that we were buying. And this, I think, is analogous to that. If they lose, if they go from 80% to 79% market share, I can live with that because I think the earnings growth is going to continue. And let's not forget AMD is in the wings, and we also own that and Broadcom, which is developing the TPUs. So I think there's a lot of ways to make money in this trade.
At what point do we move beyond the so-called picks and shovels of the AI trade and start to see the increase in, efficiency, the increase in productivity in non-technology companies?
So we listen to the companies, Tim, and let me give you one great example. We've talked about it before, but Walmart is our poster child of our investing theme, which is an old economy company that has pivoted to the new technologies and is now going to be listed on the NASDAQ, let's remember. So they had 6% revenue growth, pretty good for Walmart, but 27% in e-commerce. That was also interesting to me, but what really got my attention was that delivery speeds were up. 35% of digital orders are arriving in under 3 hours. They're also using automation in the fulfillment center, so 50% of their orders are fulfilled automatically via robot. We own the company that did all that for them, Symbotic. So that's a second or maybe even third derivative player in AI. So I think it's broadening out. We're hearing it from all across. Raytheon talked about how they were utilizing AI in order to improve supply log jams. That's a stock we own in TGLR. All of these we own there, actually. So I think it's important to start listening to the companies, paying attention to who's seeing margin expansion, and we're definitely seeing it at the company level.
Nancy, if we were talking a week ago, I think we'd have started our conversation focused on the idea of a bubble, maybe concerns about CapEx spending, the hand-wringing that we saw last week over some of these valuations that has seemed to recede just a little bit this week. But you've been through multiple cycles, and I'm wondering how you view the whole AI bubble talk right now compared to, let's say, the tech boom of the late 90s and bust as well.
Well, I wish I was as clever as Ed Yardeni because he coined this phrase too, but I wrote a piece called The Bubble and Bubble Talk. And I think it's important to note a couple of things. In the 90s, from 96 to 2000, the growth stocks whose valuations were skyrocketing were actually experiencing contracting earnings. We're not seeing that now. The growth stocks in this particular technological revolution are experiencing about 20% growth on average. CapEx was also something that was healthy and then accelerated through the entire decade. We're just now starting to see that ramp up in the last couple of years. So I think it's important. And then these companies have fortress balance sheets and all this. I don't want to say, I am going to say nonsense around Oracle. I think it's important to remember that this is a company that's always had a ton of debt. Debt to equity was 427% at the end of the quarter. That's down from 780% year over year. This is all before they issued the $18 billion in debt for the open AI data center build out. This company has a history of using debt, but the PPE is up 130% year over year, while debt is only up 9%. So debt to equity will decline.
So you're not concerned at all about the price of 5-year CDSs for Oracle rising to the highest going back to October 2022? That's not concerning you?
It is. It's a pair trade, though. What concerns me more is the concentration in the market around OpenAI. And I think that has to sort itself out. Now, Satya Nadella would tell you that data centers are fungible. If we don't use it for this, we'll use it for that. And I think that's certainly true. But I am concerned about the spend. I mean, that's a company with a burn rate, right? OpenAI,
Yeah.
10 billion in revenues and trillions in spend. Oracle has other businesses. They can change, shift directions, use data centers for cloud computing. I don't like the pair trade, but I think we were added to it a couple of days ago. And I think from here, we're going to be talking about fundamentals instead of, it became the narrative stock for this bubble is overdone. We're not in a bubble.